A bad collateral issue getting worse. The government just got a bunch of tax returns, and that increases the TGA account. The TGA account is the government's spending in check-ins account because of all this new money that just came in through tax receipts. The TGA account had a massive jump up, and now there's a lot of money in it. But what happens every month? Janet Yellen comes out and issues a variety amount of bonds. But because there's a big jump in the TGA account, instead of them issuing a lot more bonds, or short durated bonds, which are called T-bills, instead of them issuing these T-bills, instead they can just draw down their TGA account and pay off their debt. The problem arises is in the global financial system, T-bills are the most necessary item in the entire world. Everybody needs T-bills for collateral. When you're doing a repo transaction, when you're doing these agreements between different peoples, you always need to put up, if someone's getting cash or if someone's getting collateral, you always have to put up collateral. And the best, most pristine point of collateral is short durated T-bills, which are these 1 month, like going out all the way to like a year, 2 year. You can use a bunch of, you can use literally anything for collateral, but the best, most primish example are these short dated T-bills. And because the TGA right now is running down their account instead of issuing new T-bills or bonds every month, that is going to cause some real potential risks. The reason for this is we see right now reverse repo just hit a new all-time high the other day, and that is most likely because people need collateral. The 4-week T-bill is actually trading below IOR, which is interest on reserve. Why would there ever be a situation if you can just hold your money in the bank and get more of a yield if you're a bank? Why would you buy a bond if it's yielding less? There is no mathematical reason for you to do that. Logicalistic point of view, you would never ever buy something that is yielding you less. The only explanation is that there's an alternative usage for that instrument. And the example is if you are using that to artificially prop up your balance sheet or to go into the repo market and get a short dated loan. And we see repo fails spiking right now. Therefore, there's a need for collateral. And Janet Yellen, when there is this absolute need for this instrument, she's stripping away the instrument where they get them from. And that could potentially cause massive risks in the system.
The US government, when it doesn't have enough money in its checking account, issues treasuries. When it issues treasuries, in addition to the US government being able to fund itself, there are other entities besides the United States government that desperately need treasuries for their own internal operations, if not for the sinister reason of propping up their balance sheet, at least for posting and maintaining various collateral per whatever contractual obligations they have. The catch is this: because we just had tax season in the United States, the US government's checking account, for lack of a better way of saying it, is relatively flush with cash, meaning that the government can spend this. When the government spends this, it doesn't necessarily need to issue T-bills. So from the perspective of the US government, that's good, I suppose, because there's less debt that the government has to issue. But the downside is that there are people who are dependent upon the US government debt that they need for reasons that really have nothing to do with the United States. And if you start siphoning off and cutting the supply of this desperately needed utility, which is, T-bills in a sense, then you get a major problem. This problem is reflected by interest rates on T-bills going lower. In other words, people are paying more and more and more for the same interest rate, meaning that the interest rate that they're buying is getting less and less and less. And when this falls beneath the floor, so if it falls beneath interest on excess reserves, and it's like, okay, well, listen, if you have cash, parking the cash at the Federal Reserve, we're earning a set amount. But if you take that cash and then turn it into treasuries, you get, well, yes, you do earn less in interest. There is some other component or some other set of components that you get. Josh, I would just pause here, and not to keep harping on this, but I see this as another example of an emergent property of a complex system, where you and I can clearly see that, and hopefully clearly say, there is some reason that is driving firms to go and engage in transactions that, at least on the surface level, don't make economic sense. Now, if we also assume that these firms are probably not run by idiots, and that's probably a fair assumption, then you have to say, okay, well, listen, if our model, it doesn't make sense, it's probably because our model is missing something. So what is the missing piece or the missing pieces to our model? And again, as you said, and this would kind of be my conclusion as well, there are utilities above and beyond just having a treasury that are not necessarily apparent to the marketplace. Those utilities exceed the interest that the institution would otherwise leave on the table, even if they go for converting cash into a treasury, and the treasury pays less than interest on excess reserves, correct?
Yes. And now you might be saying, okay, well, what's the big deal? There's just less T-bills. That should be great, actually, because the government's issuing less debt. And on the surface, it sounds okay. But what actually happened? Let's do some fungible examples. What happened in 2008 when there was all this collateral being used, and one form of that collateral just no longer was seen as pristine, and that was mortgage-backed security. So everybody had these mortgage-backed securities on their balance sheets, and they were seen as if they were pristine assets, and they happen to not be. And because of that, you need to put up more and more mortgage-backed securities just to fill the same fungibility. But and what happened when mortgage-backed securities blew out? The entire financial system collapsed in the global scale, because collateral is the backbone of everything. In every single transaction, collateral is being put up. So having less collateral is completely out of this world. If you're really sharp and you've been paying attention, we know that there's a collateral multiplier effect, which just means how many hands one piece of collateral exchanges. And during times of economic prosperity, usually collateral can be transacted up to 20, 25, even 30 times. One piece of collateral, that is saying one T-bill can be used 25 times at once, pretty much. And every single person thinks that they have that they are good for that T-bill.
Yeah, and that's just the official usage. So I mean, think back to what happened with Bill Huang, because if someone's going around, let's say, with total return swaps, pledging the same collateral to multiple banks,
there's no way to actually track this. This is just stuff from deeper work through people like Jeff Snyder. So we know that that's happening. So then you could say, well, Janet Yellen's going to issue less T-bills. Why does that matter? Because the free market, they can just go out and do this on their own. The problem is there's fragility in the system. And when there's fragility in the system, people are less likely to feel comfortable doing these collateralized loans with so many different people. And when the collateral multiplier effect goes from, say, 20 times to maybe 10 times, 5 times, the supply of T-bills is actually going from, let's say, 100 trillion down to 50 trillion. If the collateral multiplier decreases by 50% or 100%, that is just going to cause massive pain. What if there was 50% less dollars available just at a flick of a hat? That is going to have the most big, like, humongously deflationary pressures. And the same thing, because collateral is almost the same fungibility as dollars when you're talking on this massive financialized scale. What do we actually think can happen from this? Some things that are happening right now is the dollars is rising, reverse repos going up. I expect these trends to continue. Probably see some fragility in the system if the collateral problem is as problematic as we suspect that it is.
I'm keeping a really close eye on the 10-year, the 2-year, and the Dixie.
The 10-year hit 3% today, which is pretty big news.
Yeah.
Besides that, this is just something that we have to look for, because if you are trying to manage a short position, we'll say this again and again, you have to ever expand your balance sheet and have all players agree to play by the game. And when more and more cracks are coming in the system, that could potentially cause blow up of the short position. There's a lot going on coming into the next few weeks, especially towards June and OPEX and all these FTD exposures and everything happening with the dividend split. So there's a bunch going on, and we'll keep you guys updated. Justin, do you have any last thoughts?
Josh, well done. See you soon.